Hello, Matthew Copley here with Copley Financial Group. And today we're going to do a market update and get you up to speed on what is going on in the financial markets. We're going to talk about some of the geopolitical stuff going on, the bombing in Iran, what's going on with the financial markets, some of the economic data we're seeing, and some of the fantastic new options that we have for the investments and hedging your portfolio against the market risk that we see is potentially coming. First, let's talk about what's going on in the world. We recently saw the United States bombing the nuclear sites in Iran. This is creating all kinds of headlines around the world. All of the media is up in arms about what is going on and how this is going to affect the financial markets. We've seen a spike in oil prices. People are worried about Iran closing the Straits of Hormuz, which would really affect oil prices, potentially spiking oil prices up. I honestly believe my take on this is going to be a nothing burger. Nothing is going to come of this. I think that Iran will probably have some kind of response. They'll probably fire a bunch of missiles near a U.S. base, and they'll put it all over Iranian television that they retaliated against the U.S. But it'll probably be, the U.S. will probably be told in advance, and it'll probably be all staged for the Iran media. I do not believe they're going to close the Straits of Hormuz. Their economy would be devastated. It would shut down the oil leaving Iran for China and other places where they're selling this oil. It just wouldn't make a whole lot of sense. I think that Iran is not going to do anything with this. It's going to have no political impact. And I honestly believe that oil prices that have recently spiked are going to come right back down. We have a supply glut of oil out on the markets. I do not see that changing. The United States is an exporter of oil right now. We are selling way more oil to the world than we have in the past. And looking at the amount of production that we can do with all the new technology, with the shale production and everything else that's going on, the United States is going to continue to be a net exporter of oil, and this will continue to keep oil prices down, which is good for the overall economy. Any companies that rely on oil and gas to fund energy and things for their businesses are going to pay less for that energy. And so this is also going to be beneficial to a lot of the growth in the artificial intelligence, the data centers that are going in all over. Having cheaper oil is a good thing for the overall economy. And I think that a lot of the producers, especially the domestic producers here in the United States, will continue to make good profits even at current levels. I do see oil prices dropping back into the 60s, even into the low 60s going forward, just because of the current supply and demand. Again, I don't think Iran is going to be any issue at all on the financial markets. It is possible if they created some nuclear bomb and set it off, or sent a nuclear bomb at Israel, obviously all bets are off. Things can change very, very rapidly. But I think the response is going to be terrorism is the real issue. I don't think there's going to be any response from the actual government of Iran at all. The real concern that I see is not Iran. It's actually global liquidity. This is the amount of credit available in the world to refinance existing debt. The current system that we have in place means that there's a lot of debt. There's a lot of money that's owed by the United States government and other governments around the world. There's a lot of debt that's owed by corporations. And that debt, in order for us not to have some kind of a liquidity event or some kind of a problem, needs to be refinanced. And under current interest rates, which are quite high, that global liquidity is shrinking. In fact, the actual money supply is shrinking. I really don't understand what the Federal Reserve is doing or what they're waiting for. They really need to create some additional liquidity in the system. If you look at the M2 money supply, it's actually lower today than it was in 2022. So we're seeing a potential for a real problem with the markets. And everyone talks about debt to GDP, which is definitely something to look at. We have a very high debt to GDP ratio. This is something that economists look at as a potential for too much debt in the system, and I agree it's a problem. But the real one that I'm looking at is the liquidity, and that is really when you look at the debt versus the global liquidity, because that debt's got to get refinanced. And if that refinances at really high rates, it may be a rate that corporations can't pay. It may be a rate that causes all kinds of financial crises. So the global liquidity is something that I'm watching. That is my real concern. Iran is not a concern. It's the global liquidity that I'm watching. And that is something that we should pay attention to and obviously position our investments in order to protect ourselves from some big deflationary or drawdown event in the credit markets. Overall economic data worldwide is pretty weak. We are seeing a lot of problems in all of the economic data. I was just at a financial conference in Canada last week. A very nice conference. Gradient Investments put it on. One of the companies we do a lot of business with, offer a lot of products for our clients through them. And what I noticed in Canada was that the Canadian economy just didn't feel like it was doing very well. Going out to restaurants, a lot of empty tables. The hotels, not a lot of people, very empty in the hotels. I felt like the economy of Canada was not doing so well. Obviously, we're seeing that in a lot of the data, but I just felt it being there in Canada. Wonderful trip, by the way. Highly recommend Quebec City. Very, very nice place. It reminds me of Europe. It's like going to Europe without having to leave North America. So if you get a chance to make it out there, it was a very, very pretty city. But I just felt like the economy was in the doldrums. There wasn't a lot going on. And we're seeing this in economic data around the world, not just in Canada, but in other places. One in particular is China. China is having all kinds of economic issues. Obviously, they had a huge real estate bubble that burst, and they're having a real hard time with the real estate values crashing in China. The Chinese government has done everything they can to try to help with the situation. It's not really working. They've actually created over 8 trillion yuan out of thin air, which is $1 trillion in US dollars, to help subsidize the economy. And the Chinese market is just really facing a lot of obstacles. And we're seeing this all over the world in data in Europe. And we're seeing, of course, central banks all over the world. They're lowering interest rates. They're trying to get out in front of this economic slowdown. And we're not seeing that in the United States. The United States, we're keeping interest rates right where they're at. And the Federal Reserve is acting as if there's no issues in the economic data here in the United States. Speaking of China, one of the things that China is doing is they're dumping U.S. treasuries and they're buying gold. And I think this is the main driver of gold prices going up. We've seen a big increase in the price of gold. And I think that is a direct result of China buying gold, and not just the Chinese government, but the Chinese people as well. I think they're worried about the economy. They're worried about what's going on in China. And one of the things that people do when they're worried about the economy, and they're worried about inflation, which obviously the Chinese government's printing all this money out of thin air, is they buy gold. And what we're seeing is the yields on a lot of government securities around the world are going up, even in places like Germany and Japan, where yields have been very low for a long time. We're seeing those yields start to come up. And we're seeing the price of gold go up in the face of these higher yields. This is not something that's supposed to happen. This is not normal. If yields on government securities, whether it's U.S. treasuries or other governments around the world, if those yields are going up, the price of gold should be going down, because what happens is people then say, hey, I'm getting a higher interest rate on my guaranteed investments from the government, and so I'm going to go ahead and sell my gold and I'm going to buy those guaranteed higher interest rates. But that's not what's happening. So this means that there is some kind of disconnect. It's not normal, and I think people are worried about governments being able to repay the debt. And I think gold is the ultimate safe haven. That's, for centuries has been the place to go when governments have mismanaged their economies. And so this is something to watch very, very carefully and closely. And again, I think the big driver of this is the Chinese government buying gold. They're selling treasuries, buying gold. And so we want to continue to own a lot of gold, and we have large positions, way more than the average investor has in gold. But we also have to be very conscientious of the fact that gold prices have gotten quite high. They've gone up quite a bit this year, and you're seeing now potentially some exhaustion in some of those prices. Any big drop in economic data, any kind of recession that would kick off would drop gold prices. We would see gold prices probably drop along with a lot of other assets at the same time. So we do want to rebalance, and so we're doing that. We're doing a lot of rebalancing of the investments. We've made some good returns on gold, so we want to potentially trim some of those and get in a little bit more in line with what we're doing. But again, it continues to be a very important investment to continue to hold because it's the ultimate hedge against bad behavior by the government economists. And looking at U.S. economic data, we're not seeing anything different than we're seeing around the world. In fact, if you look at a lot of the U.S. data that's come out recently, it has been extremely weak, especially retail sales. And this is the big driver of the economy. This is the thing that drives the U.S. economy is retail sales, consumer spending. And we're seeing that now negative. We're seeing restaurants warning that their traffic is going down, their sales are going down. We're seeing hotels starting to warn that they're not getting the same number of people coming and staying at the hotels. The big one, of course, is the airlines. The airlines are in a recession. We're seeing big drops in the volume of air travel. One of the things that's helped the airlines is the price of oil has been a little bit lower this year. It spiked up obviously recently with the what's going on in Iran. But for the bulk of the year, oil prices have been down, and this has helped the airlines. But even with that, the amount of ticket sales is way down. We're seeing a big recession in airline data. And when you start thinking about how people spend money, one of the things that we look at is, well, if things are getting tight and people are having a hard time, with their paying the bills and spending, what's the first thing they cut? Well, they don't go out to restaurants. They don't take that trip. They don't travel. And we're starting to see that in the data. And of course, everyone says, now wait a minute, Matt, the jobs numbers are great. Everything's fantastic in the job numbers. Yeah, I would disagree. You got to look at it real carefully at those jobs numbers. The official unemployment rate is 4.2%. So everyone says that this is great. But you got to understand that the current unemployment rate is based on what's called the U3, the Unemployment 3 report. The old report was the U6, right? So if you go back and look at what unemployment was in the 1970s and say, oh gee, in 1974 it hit 7.2%, that was a really high number, and you're comparing that to the 4.2% today, you're going, hey, look, it was so much worse. But that's not true, because if you look at how they calculated unemployment data in 1974, they used U6. They didn't use U3 didn't exist. And if you look at the current U6 rate, it's actually at 7.4%. That's higher than the 7.2% in 1974. So when we start looking at the data and how they're calculating it, I'm worried about unemployment. One of the big ones was last month. If you look at the household survey, we lost 700,000 jobs. Now, this didn't show up on the 4.2% unemployment rate because they changed the labor force participation rate. This is the amount of people that are out there in the workforce. So the government said, well, we lost these 700,000 jobs, but 700,000 people retired. And so this has to do with demographics. So they're basically saying there's 700,000 less people looking for jobs in the employment market. So losing these 700,000 jobs is no big deal. But I would argue that 700,000 jobs lost in our economy is a big number, and in 1 month. So looking at the underlying data, I don't like what I'm seeing with the jobs data. I think this could be a real potential problem. You combine that with some of the other consumer spending data. Obviously, the housing market is just frozen. No one is selling, no one is buying. We're starting to see housing prices drop in a lot of cities around the country. We haven't really seen that much here in San Diego, but if you look at a lot of these markets in Florida, different markets in Austin, Texas, which is a real hot market, it's going down. Phoenix, Arizona, you're starting to see home prices drop. And so it's interesting, you're seeing a really good result in a lot of the rental markets, and people are out looking for apartments, and apartment rents are going up, and that's good for apartment investors and owners of apartment buildings. But if you're sitting on a house, it could be going down in value. Well, this makes sense. If interest rates are this high and you got to pay 6 or 7% for a 30-year fixed mortgage, and you have a choice between renting a place for $2,000 a month, or if you buy a similar house and it costs you $3,500 a month in your mortgage payment, why would you pay $3,500 a month to live in this house when you can pay $2,000 a month to live in the same house? And so you're seeing rents going up. Same time, housing prices will probably drop. Everyone is banking on interest rates coming down. I just don't know if that's going to happen. I think that the Federal Reserve, and they should, lower interest rates, but they're going to lower the short-term interest rates. These are the ones that the government is paying. If they lower short-term interest rates, that doesn't mean that 30-year mortgages are going to go down. It doesn't mean that the longer-term treasuries, those interest rates could actually go up. You could actually see the Fed lower interest rates on the short term, and actually 30-year mortgage interest rates go up at the same time. It just means the spread gets larger, which is not unusual. And this is what we can see happening. And I think people are starting to finally come to grips with what's going on with the real estate market. So this is something that we are watching, and it's a big concern. It's a huge part of the economy. So retail sales are going down. Home prices are stagnating, going down in some markets. And of course, we are sitting on a lot of debt. And that debt all has to be refinanced. So there has to be liquidity in the markets to refinance that debt. So I know that the markets are recovering and everything's great, and the market's about where it was at the beginning of the year. We had the big drop and then the rally back, and the markets are pretty much flat on the year. But looking at those numbers, I don't like what I see. I don't like what I see with some of the data. I don't like what I see with valuations. So we're being more cautious right now than we were even a month ago. I'm not as happy about what I'm seeing as far as the economic data. And you throw on a lot of the political upheaval when you talk about bombings going on in the Middle East, and the war in Ukraine continuing to go on without any real sign of peace agreement. I mean, these are some real issues, and you could have something that happens that triggers a big drop in the markets. And I don't know what that something could be. Obviously, we saw COVID was a huge one that caused the markets to dump, and other things can happen. 2008, the housing bubble collapsed. You had Lehman Brothers collapse. There's always something that is blamed on, but there could be something that happens, and when you have current valuations where they're at and the current economic data where we're at, it only takes one thing to trigger a big downturn, which could go down quite a bit. So we're going to do everything we can to work on protecting our clients' accounts, getting assets that are non-correlated to the stock market, looking for ways that we can hedge against risk. This is where the buffered index and some of the guaranteed stuff comes in, which we're going to share with you some really good news on interest rates and what we're seeing out of the new buffered indexes available. And so right now, with the data we're seeing in the economy, let's be a little bit more conservative and cautious in what we're doing on the investment side. One of the recent events that just took place was the Federal Reserve meeting, where they announced that they are not going to drop interest rates. They're going to keep them where they're at. I find this comical, to be honest with you. I have no idea what data they're looking at. We are seeing a lot of weak economic data. You're seeing even deflation in a lot of markets. I don't know what they're thinking. The rest of the world is lowering interest rates. It's almost as if they are engineering a potential recession or downturn. There is a lot of debt that needs to be refinanced, and including government debt. By keeping these interest rates really high, the only one that really benefits from this is a lot of people that have money in guaranteed interest accounts on short duration. So people that are in like the MIGAs that we offer, or people that are in savings accounts, they're getting a pretty high interest rate with these short-term rates at a high level. But ultimately what happens is that it's costing the government a ton of money. We're running massive deficits. You've got a huge amount of money that's being allocated from the government coffers to these interest rates at these very high levels. And of course, this really benefits the banks. The banks love this, because if they bring in a bunch of money in a savings account, for example, and they're paying someone 3 or 4%, they can turn around and loan more than they got on that savings account to the government. This is called fractional reserve banking. They can actually loan and buy treasuries at a higher amount and just use a portion of this as a reserve. So the banks are getting very rich. They're getting they're very happy with what they see. All the financial companies are doing very, very well with this current environment. But this could also create problems, because the longer this goes on, you're going to continue to have this misallocation of interest. The government's paying all this additional money. They're going deeper and deeper into debt, and eventually this debt has to be refinanced. And if you do lower rates at some point in the future, after this has gone on too long, what happens is, well, some of those people that had their money in the savings accounts and money market accounts, maybe they'll decide to do something else with the money, and now there's not as much reserves in order to back all these treasuries that the banks bought. And of course, this is going to require some kind of a bailout or a change in the amount of assets that banks are required to have, which will probably be what it is. Ultimately, I think what this is going to result in is government monetization. They are going to have to do some kind of quantitative easing or QE at some point in the future. They'll probably wait for some excuse like a recession in the economy or something happening, unemployment spiking up, something happening where they're able to do this QE. But ultimately what that means is much higher inflation. And that's why you keep all of your investments heavy in the good quality value stocks, real estate, gold, agriculture, energy, all the things that do well in an inflationary environment, which we'll continue to do. But in the short duration, we could actually see a deflation where some of these things, gold prices going down, oil prices going down, stock prices going down. You could see that in a short duration before the QE starts. It seems like the Federal Reserve is always behind the curve. They don't know what's going on. I don't know if this is intentional or they're just completely incompetent. You're looking at, for example, the interest rates and saying, okay, well, why did they lower 50 basis points last September, right before the election? The current economic data is worse than it was back then. Why? I mean, 50 basis point cut is a huge cut. Why would they do that? It looks political. I mean, right before the election, they cut 50 basis, and all of a sudden, now we have bad economic data, and they're not cutting at all. And then you also have to really, really pay attention to what's going on with the economists and saying, oh, well, we're seeing all this data. Well, we think in the future that inflation is going to be a lot worse. Well, before they were telling us that, hey, we don't look at the future, we're data dependent. This is what they used to say at all their meetings last year. We're data dependent. We're just data dependent. We're just going to rely on the data. Well, now you're seeing the data and they're saying, oh, well, we're not going to use the data anymore. We're not data dependent anymore. We're going to forecast that we think inflation is going to be a lot worse. And they don't have a very good track record of forecasting inflation. We all saw during 2022, inflation is transitory, right? It's temporary. Well, it was not. The inflation got really, really bad. So with their track record of forecasting, I think that they really should be data dependent. And now is the time to cut interest rates. Do it now before it becomes a bigger problem. And this will also save the government a lot of interest. And if they have to monetize it, it is what it is. I would prefer the government cut spending. I think that a lot of what we're seeing and a lot of the pushback you're seeing from even a lot of the Republicans and Elon Musk, you saw that big skerfuffle between Elon Musk and Trump and everything on social media. And I think there's a lot of pushback. People are saying, hey, look, you got this big, beautiful bill. What we're seeing is big, not necessarily beautiful. When we see all this extra spending that's going on, higher deficits, and rightly so. I think a lot of people are pushing back on that and saying, wait a minute, this isn't what we wanted. We wanted to cut government spending. We wanted to let the free market do its thing. And that's not what we're seeing with the current bill and the current economic environment. So let's get to the investment, the good news on the investment opportunities that we have today. These are great ways to protect your accounts with the current market volatility that we're seeing. And in case we do have a big pullback in the markets at some point later this year, this will be a way that you can really hedge against that. So the first is, how can I get guaranteed, can't lose, insured interest? And of course, the MYGA is a good spot for that. And I've got great news in that front. We have seen not only the rates staying, but we've seen an increase. Now we're getting 5.75% on both a 3-year and a 5-year multi-year guarantee annuity. This is a really, really good product. It's like a CD with an insurance company. What you see is what you get. There's no additional fees or costs. You get 5.75%. Now there is an option that you can get 10% annual liquidity out of your account without any penalties. That does lower the interest rate down to 5.6%. So if you want to have that access, you can opt for a 5.6% interest rate. But again, these kind of rates, I mean, if you can get 5.75% with absolutely no risk at all, it's not a bad opportunity to take some of the funds that you have, even money that you have in bank accounts in other areas that are not getting that high of a rate, to get those kind of returns without any risk is a really, really good option right now. And of course, in addition to guaranteed returns, we have a lot of income funds for accredited investors where you can get 8, 10, even 12% interest right now on, there's over a dozen options that we have that we like a lot. That are in that range. Again, you might have to qualify as an accredited investor. We only have a couple opportunities available in the alternative space that is not for accredited only investors. So reach out to us if you're interested. These are obviously not guaranteed. They're not insured. They are backed by the companies that are offering the product. So we have some ones, for example, the largest home builder in America, guaranteeing 10.5%, very, very strong return. We have largest independent operator of assisted living and memory care facilities offering 12%. So there's some really good opportunities out there. Why take the risk of potentially losing money in the stock market when we can put it in over here and have interest that is guaranteed by the company, or in the case of the MYGA, guaranteed, insured by the backing of the insurance company, which includes all the treasury notes and AAA corporate securities that are there. So very, very strong guaranteed interest rates. It's something you definitely want to take a look at. The increase in the MYGA was a surprise to me. I did not expect to see an increase of 5.75% guaranteed rate. It is something that I would encourage you to take advantage of. I don't know how long this is going to last with these rates where they're at, but it's a way you can lock in a good return either for 3 years or 5 years. Why would I lock in for 5 years, an extra 2 years, if I only have to lock in for 3 and get the same rate? Well, it guarantees that higher rate for an additional 2 years. So if rates did come down, you would be locked in at that higher level. That's why some people are opting for the 5-year, just to lock in that guaranteed return. So the other one that we like a lot is, of course, the buffered index portfolios. And I've got some great news on that one. We have 2 new offerings that are available. The funding deadline for these is July the 15th. So you do have to get the funds into it by July 15th, which means that if it's coming from another company, if it's not already at Charles Schwab, we have to move it from where it's at now into Charles Schwab. So that can take time. The funding deadline is for the funds into the investment on July 15th. So realistically, you have to have the funds in cash available by July 14th for us to be able to fund it. And so just keep that in mind. Some of the people that have been really excited about getting into this investment have struggled to get into some of the buffered indexes because they've had to move money from other sources. Well, we got another bite at the apple for this barrier. This is the 5-year buffered index portfolio. Super excited about this. I didn't know how long this would last. We're now 3 months, 3 different offerings. It was 195%. I couldn't believe it. Can it get any better? Yes, it can. We're at 197% now. So if you go into this product, it's a 5-year buffered index portfolio. It has a 50% barrier on it, which protects the account as long as the market doesn't drop more than 50%. Your principal is protected, and you get 197% participation with the S&P 500 Futures Index. This is an opportunity. I mean, can you beat the S&P 500? Yes, we can. This is a way to do it. A guaranteed 197% participation rate is tremendous. So I know a lot of people are taking advantage of this. It's a very, very popular product. I encourage you to take a look at it. I don't know how long it's going to last. I mean, normally for years I've seen these different kinds of products, and with a 5-year lock you might get 140 or 150% participation. To get 197% participation rate is not something normally we see. And I thought, oh, we got it once and that was it, or maybe 2 months. Here we are on the 3rd month. So I don't know how much longer this is going to last. but it is a tremendous opportunity to beat the S&P 500. Great product. The 2-year one we have is very similar to the ones we've had in the past. It has a 20.10% cap, which means 20.10% cap. So this is where if the stock market goes up, S&P 500, over the next 2 years, you can make up to 20.1%. So if the market's up 15, you're up 15. Market's up 20, you're up 20. If the market's up 30%, you're only going to be up 20.10%. So that means that you're going to give up everything above that 20% level if the market goes up. Well, that's okay, because in exchange for giving up everything above 20%, we're able to buy a dual directional 20% insurance policy. This means if the stock market goes down, not only do you not lose money, you make the inverse return. So if the market is down 10%, not only do you not lose any money, you make 10%. If the market's down 18%, not only do you not lose, you make 18%, all the way down to 20. Now, in the event the market drops more than 20% over the next 2 years, it is just a maximum 20% reimbursement. So you can lose money with that one. If the stock market was, say, down 25%, you would get reimbursed for 20%. You'd still be down 5%. This is a great way to invest in the stock market and have some real protection and still make great returns. If you look back over the last 100 years, there's only like 4 or 5 years that you would have lost money with this strategy, because you take every single year that's down anywhere from 0 to 20% and you turn it into a positive year. And looking at these graphs on all the previous years, by giving up some of the years where the market's up 30, 40, 50%, you're not going to be up as much because you're capped. But all the years that the market is down 10% or down 15% or down 12%, you turn that into a positive return. It's an absolute huge result for your investments and your retirement over time. Understanding that when you lose principal, it takes more money to get back to even. For example, if you lose 10%, you have to get 11% to get back to even. But if you lose 50%, you got to get 100% to get back to even. So by limiting your downside loss, it really, really will help increase your returns over time. And this is true for also diversification. One of the things that sometimes I hear from clients is, Matt, I'm going to compare you to a certain market. Say, I want to look at all of my investments and I want to compare it to the S&P 500. Well, that is a comparison where you would assume that we would just put all of your money in stock investments. That's a very risky proposition. We certainly wouldn't want to do that. So comparing all of our results to one particular product or one particular asset class doesn't make a lot of sense. And I'll give you an example. The Dow Jones opened at 800 January 1st, 1964. The Dow Jones opened at 800 January 1st, 1981. That's 17 years of the stock market being the same level, right? Up, down, lots of volatility. Very, very bad time to be in stocks. And so you certainly wouldn't want to have all your money in the stock market during that time. And sometimes I hear from people, well, Matt, I want to look how good gold is. You look, all your gold investments are way up this year. We're up 30, 40, 50% on our gold investments. Why don't you have more money in gold? Why didn't you put all of my money in gold? Well, look at gold in the history of gold. Yes, it's done very well, and we have good positions in it. We have much larger chunks than other advisors recommend at this point, because I do think it's a great hedge against US dollar risk, and I think it's a great way to combat some of the inflation that we're seeing. But you also have to understand that gold went up from 1970 to 1980. It went up 20-fold. It went up 20 times, 2,000% return. Right? Well, then the next 20 years, gold went down. It actually went from $800 all the way get down below $300 an ounce. So over the next 20 years, you saw gold prices absolutely collapse in nominal terms, and even worse in inflation adjusted terms. So if you had all your money in gold in 1980, say you had $1 million in gold in 1980, by the year 2000, you'd only have about $250,000 in gold 20 years later. And so when you start looking at all of the different types of investments, it's very important that we diversify asset classes. And so this is where you have some of the money in gold, you have some of the money in stocks, you have some of the money in real estate, you have some of the money in fixed income, guaranteed interest, and we're not going to have the best performance in any one particular year because we're diversified among a bunch of different asset classes. But over time, this produces really good results and it reduces the drawdown risk. It reduces your principal coming down. When you go back and look, this is what's called the permanent portfolio. You go back and look and say, I'm just going to put 25% of my money in fixed income, 25% of my money in commodities like gold, 25% in real estate, and 25% in stocks. And you look at the results, you're getting close to a 9% annualized return. That's a great return. It's a great way to invest over time. And when you look at the drawdowns, in 2008, when the stock market was down, 50% in October of 2008, closed the year down 37%. The permanent portfolio had the worst year ever, down 12%, right? I'd much rather be down 12% when the stock market absolutely collapses. And you look at over the last 50 years, there's only been like 4 other years where the market was even down with the diversified portfolio. They'd only be down maybe 4%, 1%, 2%. There's years where the stock market has really dropped, like after the dot-com crash in the year 2000. Think about if you were getting ready to retire, that's the beginning of your retirement, you have this huge impact. What if you were retiring right in the middle of 2008, huge crash and all your money's in stocks? We don't want to do that. We want to be really, really smart about how we are diversifying all the different investments, and we just want to get a safe, quality return over time. We want to make sure that we're hitting all of our retirement goals. We're getting some good returns, but we're not taking on too much risk. Well, I hope that was a good market update. I will wrap up with a couple points I want to make. Number one, July 15th is the deadline. I know some of you missed out on being able to get into that 5-year, 195% participation in the S&P 500. Well, now we have 197% participation. Get on it. We only have a couple weeks. July 15th is the deadline. So if you are interested, call us, email us, support@copleyfg.com. That goes to our whole team. They make sure that things happen on that. So support@copleyfg.com. Reach out to us if you're interested in that. Take advantage of the current environment of 5.75% guaranteed insured interest rate, 10%, 12% for accredited investors on some really high quality income funds. Take advantage of what we're seeing out there in the marketplace right now, and I hope to see you in our Mission Valley office very, very soon.